The taxes you pay to HMRC come in two forms. The first is direct taxes. These are charged on income, profits or other gains. They're either deducted at source, for example payroll taxes, or paid directly to HMRC. The main direct tax for limited companies is corporation tax, and for individuals, sole traders and partnerships, it's income tax. The other form of tax is indirect tax, which is charged on spending. The indirect tax which we'll look at is VAT. In this case, it's the responsibility of the seller to pass the tax on to HMRC. This is a tax charged on UK resident companies based on their profits. The corporation tax rate is set annually by the government, and for the 2018-19 tax year is 19%. You must register your company for corporation tax with HMRC within 3 months of setting up the business. Each year, a company is required to complete a corporation tax return called a CT600 and file it online with HMRC. Normally, this must be done within 12 months of the company's year-end date. But an important point to note is that before this 12-month filing deadline is reached, any corporation tax due must be paid electronically to HMRC. The payment deadline is 9 months and 1 day after the end of the accounting period. And it's the responsibility of the directors to ensure these deadlines are met, and HMRC will issue penalties for late filing of the return or payment of any tax due. A company pays corporation tax on profits from its trading activities, income from its investments, any chargeable gains from selling assets for more than they cost. If the company is based in the UK, it pays corporation tax on all its profits from both the UK and abroad. Any trading losses made by a company can be carried forward and offset against any future trading profits, which reduces the future tax liability. Alternatively, they can be set against the company's total profits for a specified period. Even if the company has made a loss and has no payment to make, a CT600 return must still be filed. This is the tax charged on the income of individuals, sole traders and partnerships. Income tax is assessed for each self-assessment tax year which begins on the 6th of April in the year and ends on the 5th of April in the following year. Most people pay income tax through PAYE, which is deducted from their wages before they receive their pay. If you have other sources of taxable income, you must complete a self-assessment tax return. This can be done using a paper form or online. Once the tax year has ended on the 5th of April, paper returns must be submitted by the 31st of October. If you file your return online, the filing deadline is extended to the 31st of January, and any tax due must be paid by the 31st of January. The types of income which are taxed include money and benefits from employment, profits you make from being self-employed, some state benefits, most pensions, rental income, investment income above tax-free thresholds. There are several allowances which can reduce your tax bill. The most common ones are a personal allowance of tax-free income and allowances for savings and dividend income. The rates of income tax vary. For the 2018-19 tax year, income above the 11,850 personal allowance up to 46,350 is taxed at 20%. Income above this up to 150,000 is taxed at 40%, and any income above 150,000 is taxed at 45%. If you find yourself in a situation where you have paid too much tax, you can request a rebate from HMRC. PAYE stands for Pay As You Earn. It's the system for collecting income tax from your earnings or pensions during the tax year. As with all forms of income tax, the tax year begins on the 6th of April in the year and ends on the 5th of April in the following year. How often tax is taken off depends on how often you're paid, usually weekly or monthly for employees. HMRC will calculate a tax code for you and send it to your employer. Most PAYE codes are made up of a number followed by a letter. The letter relates to the type of allowance you're getting, and the number shows the amount of the allowances which may be set against tax. Your employer then uses that tax code to work out how much tax to take off your weekly or monthly pay or pension, using the income tax rates and banding for the current tax year. They pay over that tax and national insurance contributions if appropriate to HMRC on a monthly basis. You'll be given a pay slip each time you're paid. It may show the tax code your employer used to work out the tax to deduct from your gross pay. If you're employed at the 5th of April, the end of the tax year, your employer will give you a P60 end of year certificate by the 31st of May. This will show your pay, the tax deducted, and usually the final code operated. It's always worth checking your tax code to make sure it's correct. If you leave a job during the tax year, your employer will issue you with a P45, which shows your pay and the tax deducted for the tax year to date. You give this to your new employer when you start another job. National insurance contributions are payments based on your level of earnings. They help to fund the UK social security system. You pay national insurance contributions to qualify for certain benefits and the state pension. To pay national insurance, you need a national insurance number. You have a national insurance number to make sure your national insurance contributions and tax are recorded against your name only. It's made up of letters and numbers and never changes. If you don't have a national insurance number, you can request one. You pay national insurance if you're 16 or over and either an employee earning above £162 a week, self-employed and making a profit of £6,205 or more a year. There are different types of national insurance known as classes. The type you pay depends on your employment status, how much you earn, and whether you have any gaps in your national insurance. Employees pay Class 1 national insurance contributions of 12% on wages between £702 and £3,863 a month, and 2% on wages above this. Contributions are collected by payroll deductions. As well as their own contribution, employers also make a national insurance contribution on behalf of their employees. Both these contributions are paid over to HMRC monthly. If you're self-employed, you pay Class 2 national insurance of £2.95 a week if you have profits of £6,205 or more a year. If you make profits of £8,424 or more a year, you pay Class 4 national insurance of 9% on profits between £8,424 and £46,350, and then 2% on profits over £46,350. Most self-employed people pay their national insurance through their self-assessment tax return. If you have gaps in your national insurance records, you can voluntarily pay Class 3 contributions to make up the shortfall. The main reason for doing this would be to ensure you have 30 qualifying years of contributions so that you receive the full state pension on retirement. VAT is an indirect tax on spending and is charged on certain categories of goods and services sold in the UK. Certain types of goods and services are exempt from VAT. The most common ones are insurance and finance, education and training, and charity fundraising. For goods and services that are taxable, there are 3 rates of VAT charged. Standard rate is charged at 20% and is the most common and covers supplies not specifically included in one of the other categories. Reduced rate is charged at 5% on, for example, children's car seats and home energy costs. Zero rated, as the name suggests, is charged at 0% and applies to non-luxury food, children's clothes, books and publications. If you're an individual, the answer is no. Although you are paying VAT when you buy goods and services, you're not directly responsible for paying it to HMRC. If you operate a business, with vatable turnover greater than £85,000 in a 12-month period, the business is required to register for VAT. The business must then charge VAT on items it sells at the appropriate VAT rate for the category of goods or services. This VAT is collected when payment is received from customers and accounted for to HMRC on a quarterly basis. The business must pay HMRC the net of the VAT on its sales after deducting the amount of any VAT it has paid on business purchases. Any VAT due must be paid to HMRC within 1 month and 7 days of the end of the VAT quarter. If the business has paid out more VAT on purchases than it has received on its sales, it can request a rebate payment from HMRC. If you have any queries on any of the taxes, please get in touch with us. We'd love to help.